Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today we're asking, rising yields, the inflation warning markets ignore versus rising yields aren't a warning, they're a signal. Let's hear from the hawk and the contrarian.
The bond market is not confused. In 2 weeks, the 10-year Treasury yield jumped 26 basis points from 4.13% on March 5 to 4.39% on March 20. The 2-year climbed 31 basis points.
Everyone's panicking. Yields are surging, the bond market is selling off, and the financial press is spinning doomsday narratives about inflation spirals and rate hike cycles. The 10-year Treasury hit 4.39%.
PPI jumped 0.7% month over month. Consensus was 0.3%. That is not a miss, that is a signal.
Cast your mind back to 2006. The 10-year Treasury yield averaged above 4.7%. The economy was growing.
26 basis points in 2 weeks on the 10-year. 31 on the 2-year. These moves are not driven by strong GDP prints or blockbuster employment data.
The 10Y2Y spread widened to 0.51 percentage points. The curve is steepening. Bear steepening, where long-end yields rise faster than short-end yields, is the bond market's way of pricing future growth.
The Fed cut 58 basis points between September 2025 and February 2026. It did so into a PPI print that was building. It held rates at the March 2026 meeting while the bond market sold off hard.
The Iran-Israel conflict drove an oil surge starting in late February. That's showing up in PPI, a 0.7% monthly jump against a 0.3% expectation. Markets are now pricing out every rate cut for 2026, with some traders pricing in hikes.
A steepening yield curve between a cutting Fed and a selling bond market has one historical analog, the Fed losing credibility on inflation. In 1994, the Fed was caught flat-footed as inflation expectations de-anchored. Yields surged.
Here's the argument nobody wants to make: rising yields are beneficial. For the first time in over a decade, savers earn real returns. Money market funds yield above 4%. The Fed held rates at its March 2026 meeting. Rates have already fallen from 4.22% in September 2025 to 3.64% today.
The data speaks without ambiguity. PPI up 0.7% in 1 month.
Two very different takes. The hawk and the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.